Well, hello and a very warm welcome to this webinar, Investment Opportunities in Energy Infrastructure within the context of Europe's long-term energy reorientation, brought to you by Scope Ratings. My name is Keith Mullin and it's my absolute pleasure to be hosting today's session. Now, energy security in Europe has, of course, become one of the most urgent policy themes since Russia's invasion of Ukraine, and the war has clearly highlighted the shortcomings of current strategy. What a renewed energy policy might look like as Europe seeks long-term energy security, reducing exposure to interruptions and price volatility is, at this point, unclear. We'll try to cover some elements of that in today's discussion. Now, we're going to be focusing today on gas and renewables, and we will have some discussion of infrastructure, lending, and investment opportunities. It's worth mentioning, of course, within this context, that there are some pretty divergent country-specific requirements and needs, which we'll also talk about. So I'm delighted to be joined today by three fabulous speakers. We have Martin Zemplany, who's a senior representative of Scope's project finance team. We have Peter French, Director, Energy Structured Finance at MUFG Bank, and Rusbeh Amini, Head of Infrastructure Origination at Ampega Asset Management, part of the Talanx Group. In a moment, I'll ask Martin to run you through a short presentation, and then we'll move to a panel discussion. And we will, of course, be very happy to take your questions. So please do type them in as we go along into the Q&A function on this platform, and we'll endeavour to answer them at the end of the session. And before we close, there is a very short feedback form that we'll ask you to fill in, which will take you less than a minute to do. So when I announce that, there'll be a short pop-up. Click on the link and please do fill it in, as it helps us plan and make sure our events are geared to our audience. So that's it from me. I'm delighted to hand over now to Martin. Martin, great to see you. The floor is yours.
Thank you, Keith, for the introduction. And as Keith said, we just thought we start the webinar by a brief presentation, really just to set the scene and highlight some of the core challenges and dynamics on how Europe tries to reduce its energy dependency on Russia. And when we talk about energy dependency, of course, that could be a very broad topic involving crude oil, refined products, nuclear and coal. But what we would like to focus on today is natural gas, simply because that's probably the trickiest and the most sensitive part of the energy dependence from Russia. So let's start with the next slide. I hope everybody can see this slide popping up. So shortly after the Ukrainian-Russian war started, the EU published very quickly its plan and target called Repower EU, which is a plan to reduce the EU's natural gas import from Russia by 2/3 by the end of this year, from around 155 billion cubic meter BCM down to 53 BCM, and completely eliminate Russian gas import by the end of the decade, which subsequently has been brought forward to 2027. I think that's something which people are very familiar with. It's been very widely reported by the press. That's an extremely ambitious plan. And can be conceptually be broken down into two parts. Some measures are targeting demand reduction and some measures are targeting supply replacement. Many of the details are not really clear yet, and we believe more details will come from the European Commission next week. And especially on the demand reduction side, it's not exactly clear how it will be achieved. It's more a plan and ambition than a concrete set of actions. And the numbers can certainly be debated, how realistic we will get there, but I think it's still something which needs to be taken seriously because it does set out the direction of travel. So what we would like to focus on in the context of this discussion and talking about energy infrastructure is the supply replacement mainly, which again has two components, LNG and pipeline gas. And probably the easiest to very quickly cover is pipeline gas, where the European Commission sees a 10 BCM extra capacity compared to last year, which comes from Norway, Azerbaijan, and Algeria. And that's probably what we can get. There is not much more to squeeze out from the system. That's probably as much as available by, for example, deferring maintenance and measures like that. So really the hero of the story, the key step of these measures is getting more LNG. And before I talk about the physical volumes in the market and some of the constraints of the LNG market from an investment perspective, maybe let's just get one quick detour and remind people for a very important legal issue here as well, which I think would be an interesting challenge in the future, that more than 2/3 of the gas import from Russia comes in the form of long-term supply agreements with Gazprom. And as typical in long-term supply agreements, they also set out minimum take or pay clauses. We don't always know what it is, but something around 85%. Some of these contracts will expire soon, for example, in the case of Poland and Bulgaria, and PGNiG and Bulgargas said they are not going to renew these contracts. But many of these contracts run into the 2030s, and for example, in the case of Austria's OMV until 2040. So if you actually follow the EU's plan, it's not exactly clear, at least to me, what would happen to these contracts and how exactly Europe can reduce its Russian import below the contracted level, at least without implementing a full scale of sanctions, which is a possibility, but that doesn't seem to be the plan as of yet. So, with that detour back to the physical market and the LNG plan, and maybe just kicking off and starting with the LNG supply side, talking about, the volume of molecules which are available on the global market. As we all know, the LNG market has already been very tight, and even last year before the war, and that was driving to a large extent the big increase in natural gas prices, both in Europe and Asia, from the second half of last year. This is a market which is very much dominated by Asian buyers, so mainly China, Japan, South Korea, and India coming up. And these are the big players who have the experience and the credibility on this market conducting business and typically long-term business. So the pie chart on the left shows the various buyers as of last year for LNG. And as you can see, the Asian countries are shown in different shades of gray, and they represent more than half of the market, and Europe is more around 20%. In terms of the tight market and the supply, that is going to change somewhat as we look forward for the next couple of years. There are a number of LNG projects ongoing, expansion and greenfield projects as well. And a lot of new capacity will come online, come on stream in the middle of the decade around 2025, 2026. And I think that gave initially a lot of optimism to European buyers looking for extra volumes to fill this potential Russian gap. But we should be rather cautious with that optimism, because I think one important point to recognize that when you think about these projects, all these projects were initiated and achieved FID based on demand projections which already existed well before the war and Europe changing its mind in relation to Russian dependence. So in other words, what is being built is being built to Asia and not for Europe. And as you can see on the chart, an estimated growth for natural gas demand in Asia largely matches this supply growth. So, that not necessarily will help Europe to get these volumes. So that means that Europe is facing an extremely difficult dilemma, because just taking one step back, conceptually, they can do things. We in Europe can do two things. The one option is try to compete for scarce capacity with Asian buyers, which will keep prices higher, which is of course bad for European customers. But looking at it from a climate change perspective will mean demand destruction in Asia. And what that demand destruction means in practice is that a lot of the coal to gas switch, which was an essential part of many Asian countries' carbon reduction strategy, is delayed by potentially a decade. To put the importance from a climate perspective, these numbers, Shell shown an estimate that by only switching 20% of all the coal-fired plants in Asia to gas-fired plants would be equivalent to a reduction of carbon emission, which is the same as Germany's total carbon emission, just to have a feeling about these numbers from a climate perspective. So that's one option. And of course, the other option is that Europe could go out and facilitate new supply, facilitate new FIDs on additional capacity. What that means in practice is putting on the table long-term purchase commitments. So after a 4 or 5 year construction period, a 15, maybe 20-year commitment to make sure that these investments can be recovered. but that could be potentially at odds with the carbon targets and the gas demand trajectory, what Europe had in mind before the war. And I think just a couple of days ago, there was a very relevant, interesting news coming up from the negotiations between Germany and Qatar, where Qatar was, we understand, demanding longer term commitments from German buyers to secure that capacity. And it seemed to be that the definition of long term was different between Germany and Qatar as part of those negotiations. So let's move to the next slide, which tries to show that so far I've been talking Europe as a single entity facing this challenge in a unified way, which I'm afraid not necessarily describe the situation accurately, because the EU is not an energy union, and all the countries have very different energy mix and very different exposure to the risks we are talking about. The map on the left shows simply Russian gas dependence as a percentage of their import. And not surprisingly, as we move from east to west, that dependency reduces. So Eastern and Central European countries are most exposed to Russian gas. They are the main buyers. Some exception there, for example, Romania, which has significant domestic production, but that's pretty much the story in general. If we contrast it to the map on the right, that map shows the LNG import terminal capacity distribution in Europe. So where is the capacity to regasiFY LNG in different European countries? And not surprisingly, that's pretty much an inverse picture of the map on the left. Where we have LNG facilities in Europe are very much Atlantic coast countries and some Mediterranean countries, mainly Spain, France, and the UK. Now, there is, of course, some spare capacity which can help Europe importing more LNG in the system, but there are also some bottlenecks, which means all this spare capacity cannot simply be used to import more LNG to the countries in Central and Eastern Europe. Probably the most well-noted bottleneck is between the French and the Spanish systems, because although there is something around 35 BCM spare capacity in Spain, it can't really reach Central European countries because the French-Spanish interconnector is limited to 7 BCM. So let's look at the next slide, because in that context, what will be really critical is to expand the LNG import terminal capacity, which is accessible to Central and Eastern European countries. And the map here shows some of the already planned LNG import terminals in Europe, but more and more projects keep popping up. So as we talk, so probably this map might be already outdated a bit. But most of the projects are planned to take place in the Baltic Sea, North Sea, or Mediterranean areas. What we thought could be interesting to show on the chart in the right-hand side, and not sure that might be a busy chart, is just to conceptualize what would happen if all these initially planned LNG terminal gets built successfully. And just grouping some of these regions and countries maybe a little bit arbitrarily. If we look at the demand, the volume in the Baltic countries in a broadly defined way, so there's the three ex-Soviet Baltic states, Poland and Finland, what they plan in terms of LNG new import terminal capacity, that would be sufficient infrastructure to import the gas they need. The same story is true for southeastern Europe to the Balkans, where if we focus on the EU countries of Greece, Bulgaria, and Romania, these three countries would have enough capacity to wean themselves of Russian gas by a combination of the LNG terminals in Greece, by Romania's indigenous production, and also the Azeri gas, which is being imported through Turkey on the TAP and TANAP pipelines. Where the real problem lies, and I think that has to be a focus when we look solutions to this problem and future investment, is in Germany and the Central European four landlocked countries of Czech Republic, Slovakia, Austria, and Hungary. Because the problem here is both relative and absolute. Relative in the sense of a percentage of Russian gas in their energy mix, which we've seen in the previous map, but also the absolute volumes are very large, as you can see in the chart with the blue dark color. Germany alone represents over a third of the total Russian imports, and once you put together with these four other countries, it's over a half of total Russian imports. So it's also a very large volume, which is difficult to fill. So clearly, the solution has to be focused on these countries, and there is a requirement to build new LNG terminal capacity. The next slide just summarizes very briefly some of the core investment challenges across the LNG value chain, starting from upstream and liquefaction throughout midstream, including transmission networks where new investment and improvements are needed. But following on from the previous topic, really just from this picture, because everything is needed, needs improvement in this value chain, but picking up LNG terminals, which is going to be a critical missing piece of this energy jigsaw puzzle. There are two way of investing into LNG terminal, two physical solutions to expand the capacity. One is the more classic way of building an inland terminal, which is what Europe typically has already, especially on the Atlantic coast. And the other option is effectively a floating terminal, FSRUs, which stands for Floating Storage and Regasification Units. And FSRUs are effectively floating import terminals. It's a vessel. It's a vessel which was converted from a LNG carrier. It's docked in a jetty and linked to an on-land receiving infrastructure pipeline. So far, Lithuania, Italy, and Croatia has one of these in Europe. So that's the precedent so far. And the real benefit of deploying FSRUs is, put simply, speed and cost. Just to give some idea about that, converting an old LNG carrier can be done within 18 months, potentially within a year. It takes a bit more time if it's a new built hull, which the positive side of it can be a bigger capacity vessel. But that compares very favorably with 3 to 4 years to implement a project for an land-based terminal, and those projects tend to be delayed as well. The cost-wise, the FSRUs are also cheaper, at least in terms of upfront investment cost, probably somewhere in the $350 million for a vessel, although it's also difficult to be precise because there we've seen significant inflation in this market given the steel price increases. But that compares to much higher prices for inland terminal, anything between 500 million euro to €1 billion. So FSRUs are great assets and solutions to this problem, but the key issue is capacity and availability. In that context, it was interesting that I think was last week when it was reported that Germany managed to charter 4 FSRUs through Uniper and RWE, but these are existing vessels which these companies charter from Höegh LNG in Norway and Dynagas. And the capacity planned is between 25 and 30 BCM, which could represent a big chunk of Germany's gas import from Russia, probably around half. That put Germany in a great position because they were effectively kind of early movers in that space. But again, that's probably the limit because there are as many available unchartered vessels in the world market. So there is a limit in terms of how much more this can help either Germany for more vessels or other European countries. If we look at the construction of FSRUs, that's also a very concentrated market. Historically, it's been concentrated on 3 Korean shipyards of Samsung and Hyundai and Daewoo Shipbuilding. And also now China is coming up, mainly the Hudong shipyard. But this is a very concentrated market, as I said, and the capacities are fully booked pretty much until 2024, we understand from press news. These companies have seen very big demand already for vessels, mainly for LNG carriers, even before the war for last year. So it is probably important for all the countries and companies looking for FSRU capacity and go out and try to secure some slots, but there is as much as they can do again. One comment on FSRUs from an investment perspective, these can be great assets because linking back to the previous thought, these can mitigate to an extent stranded asset risk. And I think stranded asset risk is something which is a major consideration across the whole value chain because we see an element of contradiction between the time needed to recover initial investments for these type of assets, which again typically can be 20 years, and as opposed to Europe's carbon reduction goals, which means that there is a risk from an investor perspective that maybe Europe doesn't need that gas-related infrastructure which they are trying to put in place, and therefore might represent a loss to the investors. So from that perspective, FSRUs can be a great asset, because once they are no longer needed, they can quite simply sail away and be redeployed at another part of the world, assuming there is demand somewhere else in the world. And just putting my rating agency hat on, I think that's also would be a very important consideration from a credit and rating perspective. If you look at the potential recovery in a future scenario where the underlying demand of the asset changes substantially, from a rating standpoint, this would be quite credit positive under our project finance methodology, which puts a great emphasis on the expected recovery of project finance transactions. There is probably a lot else to talk about, both about this sector and others and the challenges we have, but hopefully this provides a good overview of some of the key challenges across the LNG and natural gas chain, and hopefully it's a good point to invite our expert guests to join and expand the discussion. So back to Keith here.
Good. Thank you very much, Martin, for those comments. I think you covered a lot of ground there in a very short space of time. So I wanted to bring in Pete and Rusbeh, but actually, gentlemen, before you actually comment on what Martin said, can I just ask you to perhaps expand a little bit on your engagement with this world? I mentioned at the beginning what your titles were, which are fairly transparent, but it'd be good to get us a bit more context around this. So Pete, could you just explain exactly what it is that you do at MUFG?
Sure. So I work in the energy project finance team at MUFG. I've been at the bank for almost 15 years, with a focus exclusively on natural resources project financing over the last 10 years. And so I've predominantly focused on midstream and downstream projects. That includes pipelines, including the Trans-Adriatic pipeline a few years ago, where we were dot bank, and the Saudi minority sales of their oil and gas crude pipelines more recently. It also includes things like petchems and refineries, and most recently have worked on my first hydrogen project, or am working on my first hydrogen project. And so I've been involved, both on the lending and the advisory side, but with a geographic focus very much on the EMEA region. So,
thanks. And Rusbeh, can I ask you to perhaps expand on your role at Ampega?
Yes, of course. So basically, Ampega, as the captive asset manager of the Talanx Insurance Group, is managing the around about 170 billion of assets that a diversified insurance group has under management. The team that I'm looking after is looking into infrastructure and energy and renewables investments to diversify some of those funds into areas that are creating predictable long-term cash flows, and we get to the predictability characters of investments in that area. I think Martin has already touched on that. Really, it has been a common theme around across institutional investors, insurance investors, to both address the low yield environment, but also to drive the ESG agenda of institutional investors. And in terms of what we've done to date, I think as a team over the last 7-8 years, we've made about 50 investments in 12 countries, very energy heavy. In gas, we've invested more in downstream and pipelines and storage assets, but our focus has been really in renewables when it comes to energy. And there we've worked also on 3 offshore wind parks, raising around about 2 billion of debt for those with like-minded institutional investors. And all 3 transactions have also been rated by Scope Ratings. So I think that's, in a nutshell, where I come from and the focus we have.
Okay, very good. Thank you for that. So Pete, let me go back to you then. So Martin made, I guess, some quite a lot of comments there. What's your immediate take? Can you give us perhaps some follow-on thoughts? Do you agree with what he says? Do you have some areas where you disagree? What's your general take on the presentation and what Martin said?
I think a pretty similar view, actually. I think Martin has covered all of the main points around gas infrastructure, and and the size of the challenge. So I think, really it's just a few sort of observations, complementary sort of macro points to make, which I think largely reiterates what he said. So I suppose the first one is, the situation right now is very uncertain and complex. We know what's happening to Poland and Bulgaria. Who knows what might happen to other countries in terms of their contracts with Gazprom in the near term. And there really is no one single route to replacing a baseload of 150 BCM of Russian gas. And so I think the way that MUFG would probably see it is that renewables and carbon-free fuels probably have to remain the core of the medium to long-term ambition and solution. And we do think that there needs to be a doubling down of investments here in the short term too. But it does seem, unavoidable that gas infrastructure is going to need to be built out over the next few years. And of course, as Rubeza alluded to, there are ESG, points to tackle around that. So I suppose that's the first point. I suppose the second point is that, Martin made it very clearly too, for these gas infrastructure investments, the solution is going to vary pretty radically country to country. Some countries may be almost 100% dependent, reliant on Russian gas right now. Others like Poland have been planning to stop reliance on Russian gas for some time, and so are better placed. They've filled up their storage, they've got new LNG coming on, regas coming on, and they've got interconnector pipelines coming on very shortly. And other countries might just be able to squeeze out a bit more piped gas from Norway, maybe a little bit from Algeria, and Azerbaijan and the TAP pipeline could play a role too in future. But I think really where the core of it probably is for a short-term, quickish fit is probably LNG imports predominantly into FSRUs. And for the landlocked countries, that is a real issue. So some improvement of sort of interconnecting pipelines is, would have thought would be key, and maybe a bit more coordinated gas sourcing arrangements, throughout Europe, so you're not sort of competing with each other and driving the prices up, but negotiating in sort of a more collegiate sort of fashion. But none of this is going to happen, overnight, and some of it's going to take years. And I suppose the final sort of macro point that I'd have is, as Martin said, sort of building out the gas infrastructure is one part of it, but securing the additional gas supply is sort of the other side of the coin, and it's not a slam dunk there. So, taking LNG, which is going to feed these FSRUs, only a very small minority, I think about a tenth, maybe 50 BCM of global LNG is sort of very flexible on destination. And so, Europe is then outcompeting or trying to outcompete Asia. So, I think Martin said China, Japan and South Korea in particular on both price and terms. So, the chance of securing 50 BCM this year is going to be basically impossible. But it's it's one where they might be able to develop over the next few years. Looking particularly at some of the other countries like Qatar and maybe the US. So those are probably the sort of the three macro points that I'd have around what Martin said.
Okay, thanks. And Roosevelt, let me ask you the same thing. Whether you have any additional thoughts, and and I guess perhaps a follow-on question, perhaps I'd ask you to ponder is, we had before the war, there was a curve, there was an EU energy policy in play. There was an energy kind of a project pipeline that was already out there. Now all of a sudden, things changed. The macro scenario has changed. The geopolitical scenario has changed dramatically. So first of all, perhaps comment on what Martin said. Perhaps you can follow on with to what extent, how easy is it for an institutional investor like yourself to actually to buy into this changing scenario?
Yeah, let me start with what Martin said, and really I think the scenario that was described and also what Pete added, I think it seems to be the only quick fix, right? The scenario is that we just discussed, and clearly politicians and regulators will try everything to make sure these types of alternatives for Russian gas will be delivered. And for us as long-term investors, we also ask ourselves not just kind of how's it going to be delivered. I'm sure politicians will do a fantastic job and the market delivering these assets, but how can they be financed in a sustainable fashion, right, over a number of decades? And that's really where Martin was also saying, do we actually still need these assets in 20 years' times, right? And considering the lead times, big infrastructure projects need, and saying that from a country where it took 2 decades to build an airport in the capital, which in that time was first too small, then too big, then too small again. So you know, the world keeps changing, and as an institutional investor, we really like kind of predictable frameworks, and stable frameworks, and regimes where we can rely on you know, the market risk factors being somehow addressed, right? And I think that very much leads us to your second question in terms of the change in how the world looked for us as an investor last year and how it looks now. I think last year there was certainly much more money chasing fewer deals and transactions, and so prices would go down, yields would go down, terms would become looser. We're now in an environment where, due to clearly the changes we're just discussing, everyone is expecting a large increase in number of projects on the one hand side, to just address high energy prices, and diversifications and shortages in gas. But ultimately, kind of on the other side, where I was saying last year there was so much money chasing these projects, very few projects. Now we expect more projects, but probably less liquidity and money in the market, right? Because of the tightening of the monetary policy and increases in interest rates. So I think it needs some time to gradually work itself through the system, but clearly return expectations will go up. The prices will go up for these projects just due to higher cost. And how to ensure really kind of stable returns on these assets will be absolutely key for policymakers, and also for the market, advisors, structurers, banks, sponsors, and investors.
Yeah, indeed. Thank you. Martin, do you have anything to add on this last point, this issue of liquidity? Because clearly the financial market conditions are obviously changing, rates are going up, inflation's going up, liquidity is pretty much, it can be very spotty at times, particularly on the institutional investor side. Do you have any sort of thoughts, early thoughts about the kind of financeability aspects of the emerging project pipeline? And I get Peter, I'll ask you to follow on that question as well.
Yes, I think it really also depends on which sector we look at and how much really the countries or companies double down on various subsectors. I think if we focus, for example, on natural gas in terms of midstream, looking at a typical size of a deal and the potential pipeline and the nature of the cash flows, which Rusbek talked about as well, where a midstream pipeline can, a midstream network can either be contracted or regulated, but typically no volume, no price risk transaction is achievable. That's probably easier to finance. Where I see a big question mark from a European perspective, at least, on liquidity for projects is the supply side, the liquefaction projects, which I think Peter touched on as well. If you look back historically for the previous pipeline, that was very much supported not only by banks, and it's not really an area where institutions like to play because it's upstream, it's non-OECD, it's all those things they don't like, and probably respect, it's nothing. So I don't think it's something they would look at. But export credit agency liquidity was very important to make sure there is liquidity for those projects. But that was mainly Asian ECAs, Nexi, Kexim, K-Shore, JBIC, these type of guys. And if we look at it from a European investment perspective for any project, maybe not in the US, but in Africa, I'm not sure the European ECAs have the policies ready to invest in this sector. And I think what would be interesting to watch is whether the German ECA, Hermes, would be, for example, open for investment. It doesn't seem to be the case after the Glasgow climate change conference, but I think that would be the sort of investment signal to also potentially invite other ECAs as well. I think it's probably a bit more liquidity available for renewables, even if there is a doubling down, because a lot of capex which the oil and gas companies would have spent elsewhere, and with this free cash flow, I think that can be diverted into the renewable space. There, the issue is more increasing prices, cost inflation. That's also some emerging risk to watch in the renewable space, but that's probably beyond the liquidity topic.
Yeah. Pete, do you want to come in here?
I think just briefly. So I think sort of on the financeability point, which has been touched on a bit. I think gas does have some role in the energy transition. It's too easy to tar all fossil fuels with the same brush, but I venture that most would acknowledge gas, will play some role in the 2030s, maybe even 2040s too, including in some of the more aggressive, scenarios around, net zero and, by at least 2050, if not before. And so I think, some of the challenges of financeability here goes back to what Rizbez was talking about, where, sort of utilities, investors, banks need to be sure that governments in Europe will not sort of suddenly change tack again in 2030, given these investments have a 20-year sort of time horizon, and they need to be clear that there's sort of long-term support. And I think we are seeing some governments providing those clear mandates. So we've seen that in Germany, and we're seeing a bit of it in the Netherlands too, as well as elsewhere. And so, governments can support to help the financeability of these projects by, reducing gas network entry charges or port charges or other tariffs, or, just even designating them as, projects of, strategic national importance. So, I think that can help. I think another option is, I've seen it once in Italy, but, some FSRUs, there, or at least one, I think, has been done on a regulated structure. So usually FSRUs are sort of banked on a contracted charter, but in Italy I think there's at least one project where the Italian government essentially backstops the majority of the long-term capacity fee and then recoups it when the terminal's used. So having that government involvement will improve financeability, and to the extent you get some ECAs in, particularly European ECAs, or even some sort of multilateral support, that always provides some comfort. And then I like Rizbez's points around the ESG bit. I think you want to create a sort of a transition story wherever possible, potentially around hydrogen or green ammonia. And then I think, just the final observation, maybe using Martin's figures, which I sort of jotted down, but if we say that an FSRU, a new build will cost 350 million, and I assume that does sort of 5 BCM, even if you built sort of 10 of those, that's going to be what, 3.5 billion, and that plugs a pretty substantial gap, 50 BCM. And I'd also venture that if you can do some conversions, you're going to be building it a lot cheaper than 350, albeit prices may be going up as there's more demand. So I sort of feel that quantum is manageable if you can create a story that investors buy in, sort of around government support and their messaging around ESG.
So Pete, while I've got you there, you mentioned hydrogen. That's come up in a question actually, which is, can gas infrastructure be compatible to hydrogen and provide a pathway to decarbonization for gas? Interesting question potentially. Do you have any sort of any ready answer, easy answer there? And Rizbez, maybe I'll come to you for perhaps a follow-on.
I think no easy answer, but I mean the EU is talking about putting on 25 to 50 BCM of hydrogen to replace Russian gas by 2030, and I don't know where that's going to come from, but I'd hazard that quite a lot of it's going to be imported, probably from the Middle East, where they've got sort of excellent wind and solar for the electrolysis, and therefore the EU has definitely been talking about ensuring that LNG infrastructure is hydrogen ready. So I think if you sort of split down the hydrogen ready bit for the different bits of the infrastructure, import terminals, I think, in onshore import terminals, they do say that you can make them, ready to accept green ammonia, and green ammonia is a hydrogen carrier, essentially. Yeah. Or it could be, retrofitted, but I think that's a bit trickier. And it's definitely been discussed in the context of at least one German import terminal. I think it's the German LNG one, Brunsbüttel. And then there's another one in the Netherlands where they're talking about it too. But I'm not sure how compatible it is with FSRUs. I suspect it's a bit trickier there, although, potentially, FSRUs could be combined with green liquefaction, although I guess many would contest that point. So that's import terminals. I think gas pipelines are the other ones, because that's, often talked about as well, because, people say that gas pipelines can be used for transporting hydrogen, and they can be to a point. But I think, while some blending can be done, that probably doesn't get the premium prices that at least the early hydrogen exporters will be targeting. And there's only a certain amount that you can blend up to. So, I think if you transport pure hydrogen in gas pipelines, it does degrade, the existing methane pipelines. And so it is reasonably expensive to convert a gas pipeline into something which can convert, it can carry, pure hydrogen. Now, I don't know what the figures are, but, across Europe, you do a reasonable number of those. It's going to be 10, 20, 30 billion. So, big numbers. Storage might be a bit simpler. I'm not too sure on that point, but I think, some storage can be repurposed, but that's going to be geographically limited again to sort of North Sea, Germany, Norway. But, that might be compatible for hydrogen, I guess, being produced from wind farms in the North Sea. So that could, potentially be good. And I don't know how much conversion is required there, but I'd hazard a guess that not too much. So I think there's definitely a story there. There's definitely a pathway there. But I'd say it's not totally straightforward and it's not without cost.
Right. Rosbert, are you being shown hydrogen projects that work on economics for you at this point? Or are they more episodic than you can call it a pipeline even?
Yeah, I think it's certainly a buzzword and a trendy thing, which is portrayed as the solution to all problems of mankind. Sometimes you feel, and I completely agree with Pete that it is part of the solution, but it won't be kind of the only solution or the way. In the only way into the future, right? And so I think from the projects that we've seen being really driven and forward, it's been very much by large players in the market, utilities and providers of technology. They're like pilot projects because it's really not as much of a tested product technology, and so that's not necessarily part of our investment guidelines to experiment or provide a venture capital type of money, but it is something that is very, I think on a project by project level, you do see really interesting things. There's a big move and ideas about using hydrogen in transportation, right? To say, for example, on rail lines where we have only around about 70% of Germany's rail grid currently electrified, so 30% is reliant on diesel trains. So hydrogen is being applied on those areas, right? And it could play a role and have a place there. And considering that quite a few of, say, the renewables projects we have currently, when there's strong wind and there's low demand, they generate negative electricity prices, and you have to switch them off. So it's a complete waste, and you could use that for hydrogen, but that is not going to be sufficient to completely replace the gas from Russia or transition the economy.
Yeah, no, indeed, makes sense. Look, we have some questions coming in. Martin, I think there's a question here which I think speaks to one of your comments, which was, I think you mentioned this, to what extent can US LNG on the supply side fill the gap left by Russian gas?
No, I think there are already very much increased flows from the US, but that was starting from a relatively low base. So I don't remember the exact numbers, but I think already this year at 15 BCM equivalent is the plan to get transported from the US. So I think it's going to be important. But although there is a very significant production in the US, they also have a capacity limit in terms of their export potential, in terms of export infrastructure. So I think the same story is true, that they would need to expand that capacity. That requires time, that requires some commitment as well from buyers that money is worth investing. So I think US will be very important, but I think certainly that cannot solve the story alone. If we look at the supply side, I think Europe will have to go outside of the US as well, and Africa is also another place, although it comes with elevated political risk, which can be part of the solution. But I think the US supply will be important, but certainly not something which can be the source of all the additional LNG as part of that Russian replacement.
Yeah, absolutely. There's a question also. Sorry to keep, I guess, jumping up and down a bit, but there's some interesting questions coming in, and I wanted to make sure we answered the delegate questions as we continue our conversation. And there's one which I guess we've already touched on, but perhaps let's just revisit, which is, how do you think high interest rates and inflation would impact investments in new gas infrastructure? So Martin, you talked a lot in your initial comments about some of the investment challenges, but I guess higher returns are great for banks and investors. But perhaps let me come to you, Rusbeh, if I may, then to answer this one. Interest rates and inflation, and to what extent they may impact investments in new gas infrastructure.
I think I would like to think of both as part of the same direction in terms of question, the interest rate and inflation, because typically high inflation also comes with high interest rates, right? And so in a way, we always would think and consider, I think, of energy investments to be also partly a hedge against inflation, right? And be that in kind of commodity markets. If they're not a driver of inflation, they often, I think, do move in tandem with inflation. And so actually, it is also a way to protect yourself against inflation if the investment opportunities are then structured to have an inflation-linked component, implicitly or explicitly.
Okay. Pete, do you want to comment on that one as well?
Yeah, I mean, I think there's little to add. I mean, it's clearly very, very topical at the moment. Sort of high interest rates, commodity prices being high, and inflation is definitely not a good mix. And obviously the concern is that the cost of any new infrastructure just ends up being passed on to the end consumer, who's already a bit squeezed. And so I guess when prices are low for gas, making consumers pay a bit more for the electricity bills for capex expansion programs, less controversial. Now it's pretty controversial. And then, of course, the utilities and probably struggling a bit with the higher debt service. So I guess that's thinking about it from a different angle. But ultimately, maybe given the strategic drivers, some of those things will just have to be dealt with, and governments will have to step in a bit more. Direct state-owned banks, might provide the liquidity. If the costs are looking a bit high, that might help push it down, or the assurance of long-term government support might help depress some of those costs, and they can help out with tax breaks or the ECA support I mentioned earlier. So I think that's probably about it.
Yeah. And Martin, on this question then of the changing rate structure and how that may impact on projects, are there any kind of potential credit issues that spring to mind around this environment, assuming that we carry on? I mean, I don't think we're nowhere near the end of the rate cycle, tightening cycle. So how do you think it may affect the kind of credit profile? I know it's a general overarching question, but any kind of macro thoughts around that?
I think from a more macro perspective, and that probably touches on what others said already, to me it's part of a broader trend, which it's something which would increase the cost of the investment ultimately in one way or another, and the competitiveness of the project versus existing projects. And we also see an increase in cost inflation in commodities. So even if you talk about wind turbines, for example, all the components have seen high inflation or cost increase, steel, copper, or zinc. That's the same true for labor. And I think the rates and the financing cost ultimately is just something which adds to the price of building out the energy infrastructure. So I think what that means is there is a question mark about whether the investment can be recovered. And that's, I think, goes back to Peter's and Rusbeh's point about the governments, needing to support those investments, and especially finding a way that they remain competitive also compared to existing investments, because quite simply, and it's just bad timing for Europe, rolling out all this infrastructure we talked about and what the continent needs, it's just going to be very expensive. And the interest rates is just very important, but just part of this broader challenge.
Yeah. Okay. Yeah. Thanks. I was actually going to ask about the gas and nuclear being considered renewable under the EU taxonomy. which I did want to ask as well. But there is a question, which is, how does gas infrastructure fit into your company's ESG philosophy, and does this affect investment appetite? Yeah, let's go back and let's go through the three of you. But Bruce Bear, is gas as renewable fuel, is that a blessing or a curse?
That's a very good question, because I think initially I was talking about predictability of energy policy, and if you look at the taxonomy and then the answer to your question did change a few times over the last months and years, right? Like it was considered eligible and then not eligible, and then eligible again. I think if you had asked earlier in the year, gas would have been much lower in the kind of priority list, and now with a new situation where you really have to find replacement and have it as a transition technology. That discussion is an easier one, but that's again an area where I think there is some guidance from public authorities needed. I mean, look at nuclear, right? Because you mentioned them both in together, and basically here in Germany in the early 2000s we decided to exit from nuclear. Mid 2000s we decided to exit from the exit, and then Fukushima came and we decided to exit from the exit of the exit, and now we're considering to maybe extend. So have the force change in mind within a 20-year span. So you can't make 20 or 30-year investment decisions and then every 5 years keep changing the eligibility or social acceptance of a technology.
Yeah, that sounds like a welcome to my world sort of comment, but yeah, absolutely. Pete, let me put the same question to you, around particularly around gas as a renewable fuel at the moment. Banks and companies worldwide are basically setting themselves emissions reductions targets and net zero targets and pathways to net zero, etc. The fact that gas is considered as a renewable fuel how does that kind of play into your bank's emissions reductions targets? Because it creates somewhat of a confusing picture.
Yep, I can understand that. So I think a lot of banks, including MUFG, have a net zero target across their finance portfolio. So that's pretty broad. So net zero target by 2050, and that remains unreservedly unchanged for us. It's a key message that gets hammered into us all the time. And already we don't lend to any new coal projects in principle. We're pretty selective in EMEA on oil projects, and gas we look at carefully, but we do see it plays some role in the energy transition, potentially with fuels technologies yet to be developed. So I think the proposed gas classification on the EU taxonomy, they're saying gas and nuclear is proposed to be sustainable, I think is the phraseology. That definitely helps, because banks can then classify their lending as sustainable. Yeah. But actually, ultimately, it doesn't get you away from the fact that we have a hard net zero target. So it doesn't actually address that one, and that's what people are really focusing on, particularly internally. However, on the flip side, I would also note, given the sort of terrible events in Ukraine and the situation that we find ourselves in Europe, I sort of feel a degree of flexibility is going to have to be shown by investors in the finance community, as the EU is demonstrating itself with a bit of a change in tack. So I think, banks like MUFG will be having to consider what role do they believe gas has in the energy transition. There's a million different scenarios out there, but, one which I liked, it's probably a couple of years old now, the IEA Sustainable Development Scenario, which was in line with Paris, like in between the 1.5 and the 2. Show gas playing a very material part. Coal fell off a cliff, but gas was there, and oil was, massively reduced, but gas was still there. But that was in conjunction with things like CCS, which are not really there yet at scale. So I think, ESG forms part of every business and credit screening decision that we make at MUFG. And I suppose we need to consider this incremental gas usage that what would have been used from Russia before. Could it stop some countries burning coal? I take Martin's point about maybe displace some coal burning in Asia. And is there any sort of carbon-free fuel, hydrogen or green ammonia compatibility. And so I think, if a good case can be made here, along with addressing the sort of the stranded asset risk too, I think many commercial banks will be looking to support on gas infrastructure, but that ESG story definitely helps, even if it's, I guess, sort of embryonic at this stage.
Yeah, thanks. Yeah, if I said renewable, actually, yes, you could. I did mean sustainable. Yeah, thanks for the correction there. Look, we're running out of time, so I don't want to particularly go much beyond the hour, and we're almost there. And as luck would have it, we have I think perhaps a nice sort of question which may take us to our exit, which again I'm going to go sort of through the panel, which is Martin. Let me start with you on this one, and it's one of those "how long is a piece of string" questions, which is how long will it take to develop a feasible solution for Europe? You can't be wrong because
yeah, I guess solution for what I think, because this whole intention to replace Russian gas and what we talked about is just an additional challenge, an additional homework on the top of a very difficult investment landscape Europe already had. The continent tries to decarbonize its power grid, and that's what's been driving renewable to date. But there was already a plan to electrify the transport infrastructure, which brings additional electricity demand, and now we have effectively a big project to replace part of the existing sourcing infrastructure for natural gas. So there are very big individual challenges, and I think putting together, that none of this is going to be done overnight. I think it's a process. I don't think we can look at in 3-4 years and we are done, we've achieved the result. Certainly, it's going to be a very intense decade until all of these investments are ongoing, serving and sometimes overlapping different aims and different goals, but I think the investment needs over the decade will be very high, and I don't think at any point we are going to get to an end date. We're just going to make progress in each of these homeworks.
Yeah. Thanks, Rusbe. What's your best guess of how long it will take?
I think you will get a solution very quickly. If governments identify this to be a problem, they're very good at solving one problem at a time, and they will sit down with national champions and the big players that can mobilize capital and projects and find solutions. If those solutions are sustainable, affordable, that's an entirely different question, and I'm very curious to find out. I think we've seen with renewables, governments throwing subsidies around to encourage renewable investment and then finding out, oh, they can't afford it, and then cutting back on it. Hopefully this time there's some lessons learned.
Yeah, well, we can always hope. And Pete, on the time frame for this.
Tough. These are such tough questions to answer. I'm not very good at them. I sort of feel that reducing reliance by the end of 2027 on Russian gas, if we're just going with 150 BCM, that looks pretty highly challenging to me. I suspect that you might have a shot at doing that sometime between 2027 to 2030. I take Rusbe's point that actually governments can act quite fast. I think it was in Germany I read fairly recently that they were talking about cutting the permitting time down for, I think it was one of the onshore ones, by to a tenth of what it would usually take. So with the will there, the huge strategic drivers, I think the governments can act fast. But then you do have those other issues around sourcing, the LNG. So if we take the American ones, there's a couple coming on stream shortly, but they're largely, contracted to portfolio players, but I think one's on the wrong side of the continent. And then most of the others come up on, 25, 26, 27. And, lots of those are already contracted to a point, but there'll be some challenges there. So it's going to be a number of years before you get all of that. So I'll go for somewhere, I think, in between those two answers, 2027 to 2030, you can address the 150 BCM gap. The stuff I was talking about, hydrogen, that takes longer, right? I'm looking at a hydrogen project at the moment. It's amazing. It's big scale, but it's the first one I've seen of its scale, and hopefully others will follow it and copy it. But, by the time others do, it's making a really big material dent in Europe. That's got to be well into the 2030s, right?
Yeah, absolutely, indeed. Okay, thanks. On that note, let's close our session. I'd like to thank Martin, Peter, and Rusbe for their comments. I'm conscious this was a huge subject that I think I think we did justice to it in our hour, but this could be a conversation over days rather than minutes. So I think as this whole narrative evolves, my suspicion is that we'll do more of these events as you know at the relevant points in time. So I'd like to thank you also as delegates who took the trouble to dial in and listen. Hope you found that helpful. I mentioned at the beginning, before we disappear, we would like you very much to answer our feedback question. It literally takes just a few seconds. So be so kind to help us. Just click on the give feedback and fill that in. That is just immensely helpful to us and helps us plan for the future. So on that note, I'll give you a few more seconds to do that. And we are at the hour, so I can call that perfect moderation. Thanks again, everyone. Stay safe out there, and we'll see you next time. Thanks a lot, and goodbye from us.
Thank you.
Thank you.
Thanks and bye.